this was a once upon a time a storied company for America, but it's been mismanaged to the gills and it's been crushed. It's been a horrible performer, and they're horribly managed. I'm sorry. It's a terrible company the way it's run if you just look at the competitors in its field. So, of course, this is just Trump being Trump. And again, we talk about all the time. People think, oh, you love Trump. No, I don't. I like
Not
certain policies, right? And this is one I hate because it opens the door for a future president to do something, as well. Again, there's ways to solve this, but this is an absolute terrible move by the federal government.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, leading the news around these parts this week, David, the Big Red season is opening up. We are now a major sponsor of Nebraska football. Now, it's a little bit of a risky business here because we're recording the show before the game is actually played on Thursday night. Are you willing to go out on a limb, David, and make a prediction?
27-17 Husker victory.
I'll take that.
We give up the 17, a late touchdown, unfortunately, or it would have been by a wider margin. There's my prediction.
I'll take that. How about for the season? How do you see the season?
I'm feeling pretty good, but I've learned not to get too overzealous. So I'm going with a solid 9-3 season.
I'll take the 10-win Kool-Aid position.
I think we win. We've got 3 or 4 pretty tough games in reality. I think we lose one of those. But we win more than people think on some of those. But I think, of course, we end up losing a game we never should have lost.
Exactly.
That kind of has been our history since I've been here 8 years in Nebraska. We always seem to just let down. Now, the great news is I study data, right? That's what we do for a living. We analyze data. Yes. Matt Rule's third year.
The data says it's going to happen.
Data says it's going to be pretty strong. And he's gotten double digits at the third year of every location. So perhaps your 10 wins is right on the money. But
Michigan, USC, Penn State. Those are 3 tough games. But I see us losing only one of those. But then, as you say, we'll probably lose one. That Friday night game at Minnesota worries me. Iowa, I'm sorry.
And Minnesota, frankly, they have had our number for quite a while
Fleck
now. Yes, he's definitely dialed it in here.
Iowa, I'm sorry, even if we're 11-0, if we lose the Iowa game, Matt Rule should be fired on the spot, on the field that day. I'm sorry, you just cannot lose to Iowa anymore.
I'm excited because I'm going to be attending more games this season than ever before.
Oh, yeah, good.
I will be at the Kansas City game
you've been a
in Arrowhead.
Ticket holder for several years now.
So I'll do all the home games, plus I'm going to Arrowhead, and I am going, one of the advisors that we coach through our mastermind has invited me and one of our other advisors, Alex Murray, to the Penn State game. So I'll be traveling in November, and I will be there for the Penn State game.
I'd love to see a game there. It'll be loud, raucous. It'll be a rough environment, but I'd love to see a game in Happy Valley.
He just requested we don't wear the candy stripe, overalls. I was like, well, I think we can probably pull some out.
We'll probably have some Retire Smart gear with emblazoned with Husker
looking
logos.
forward to the college football. Now, speaking of college football, we had one of our interns had a great summer with us, who's an Iowa State kid. He's going over there, and Iowa State just pulled off the Aer Lingus, one in Ireland, and to kind of kick off the college season.
Exciting
that
finish.
Was actually a really good game.
Yeah,
and
that
the
fourth quarter was wild.
That was well played.
Yeah.
They beat K-State, and so one of the guys that coaches this is a K-State alum, actually played for K-State and Bill Schneider back in the day. So anyway, it's just great. It's exciting. You look at your face, how excited you are. I mean, you had to claw your way to get into the studio. You were so excited. Obviously, if you're watching on YouTube, you'll know what I mean.
Just getting revved up for the season, banging my head against the wall. Yeah. It was a great game. I still have some post-traumatic stress disorder from that trip a few years ago to Dublin. My kids paid for it, and I still felt like I got ripped off.
Well, I'm really excited. I've got my nephew, who's a general contractor out of Florida, coming up for the home opener against Akron. So he's flying up next week to come to his first Husker game.
Nice.
So that should be an exciting event for him.
Well, it feels like it's going to be fun again. I just want it to be fun again. All right. Into the news we go, David. Did you, speaking of red flag, you red flagged this one. You said, wrong. That was the subject line. The headline from CNBC is, U.S. government takes 10% stake in Intel as Trump expands control over private sector. I thought I was in a time warp. This sounds like Obamacare or taking over General Motors. What's going on here?
Yeah, and I'm sorry, but I am not copacetic with it. I am not happy about this at all, because what this opens the door, we talk about the government should not be the one trying to pick winners and losers. Now, I'm also, let's be clear here, I'm a huge advocate of us starting a U.S. sovereign wealth fund. But we should not be picking winner and losers. We should be investing in all the companies in the S&P 500 through the index, not to the companies directly. And that could be building. So we should take 1 or 2% of our revenue every year and put it into an investment that grows. And history has proven it will grow faster than the interest we're paying on our debt. And at some point we'll get to equilibrium and we could literally wipe out our debt. But taking an individual position in one particular company, and this is a company that is mismanaged. Let me tell you, Grinnell College, Buffett, of course, went there over in Iowa, but the founder of Intel, that's where he's from, a small college in Iowa. They've produced a ton of great folks. This was once upon a time a storied company for America, but it's been mismanaged to the gills and has been crushed. It's been a horrible performer, and they're horribly managed. I'm sorry. It's a terrible company the way it's run if you just look at the competitors in its field. So, of course, this is just Trump being Trump. And again, we talk about all the time. People think, oh, you love Trump. No, I don't. I like
Not
certain policies,
yeah.
right? And this is one I hate because it opens the door for a future president to do something, as well. Again, there's ways to solve this, but this is an absolute terrible move by the federal government. And I hope people fight it. I hope Congress fights it. You should get Congress to agree how we may invest in the private sector. And I have no problem if it's done in a way that is not picking sides, right? And there's lots of ways we can do that. If you reshore jobs in America, the government will buy 1% of your company. I mean, in other words, you could actually tie this to the economic benefit you are trying to create, but this is not a good thing.
The president is quoted in this story as saying, the United States paid nothing for these shares. Now they're valued at $11 billion. What does he mean by that?
That's smoke and mirrors. We paid for them. 100% paid for the value of those shares. And what if they go down 50% because the management has not been on top, right? And there's problems with this management, just so you know, linking giving data and things to the Chinese Communist government, just so you know, there's stories on that. So again, this has so many problems within it to me, and I'm not happy about it at all.
I guess it was funds approved from other grants, but it's still taxpayer money. I mean, we're still paying for this. So, all right, we'll have to keep a close eye.
There's no free lunch.
We'll have to keep a close eye on that one. Speaking of keeping an eye on something, this is something we've talked about over the last 2 or 3 years, David, this Evergrande, this real estate developer in China. CNBC headline, Evergrande's $50 billion rise and fall leaves scars on China's property sector. So I guess this is the summary now of the Evergrande saga.
Well, this is my point.
Conclusion.
China owns a piece of every company created in China, right? And we just talked about the Intel. This is the ramifications. They will help get companies started, but then if the company is mismanaged or things get out of control, leverage, et cetera, and that's what happened in the Chinese real estate market. When it collapses, who takes it on the chin?
You're left holding the bag.
The government, right?
Yeah.
And the Chinese government lost, and this says $50 billion. It's hundreds of billions of dollars. We've talked about this story for the last 3 years, Chip. I brought this up, and now it's collapsed. It's delisted. The company is out, bankrupt, defunct, completely gone.
The story says more than $300 billion in debt.
Yeah. And so who covers all that, right? So the government just has to print money. In this case, it's China's government, but that's the same thing that could potentially happen here. And if we go crazy with the printing presses, which sadly I think is coming again, right, with what I read the tea leaves, that will create long-term problems with inflation, et cetera. Unfortunately, we are in such a partisan environment that one party wants to run something they think is a good idea and the other party's all against it, and then it'll swap, right? And they'll do it again. Tell your congressmen, tell your elected officials, the government should shrink itself and get out of the way, and then our economy can grow. Free markets work, and I think I sent you a story we might cover later on Argentina that proves just that.
Javier Milei, that is indeed in our lineup of stories. Let's see if we can squeeze this one in, David. Well, this is a chaser because you brought this up last week, new homes being cheaper than existing homes, and there's additional data proving that point.
Yeah, so we, for those of you watching on YouTube, we actually have a chart or a graphic on the screen showing you that basically existing houses, the median is somewhere around $415,000 or so that people are listing to sell. New homes, Chip, are listed about $409,000. So for the first time in history, new homes are listed for cheaper than existing homes. And you and I just talked about this last week, right? A new home, new warranties, brand new construction, typically it gets a premium 5 to 10% more than existing home. But then when you take into the incentives, these large builders that Warren Buffett just took a massive stake in, and here we're referencing Lennar Homes, after incentives, that's buy down of the mortgage if you use their mortgage title company, additional upgrades to the home they're going to give you for free because they're trying to blow out their inventory. The price is really effectively about $350,000. So you're talking about a $60,000 to $70,000 gap on a $400,000 price home. That's 25%. Who is going to buy a new home or buy an existing home down the street if they can go 2 streets over and there's a new neighborhood and get 70 grand off? Essentially the same product.
Right. Mm-hmm.
So if you're out there, and I actually had a friend of mine who is a client that owns a couple homes, and he was listening to the show. Should I drop my price or should I hold them? I was like, well, giddy up. If I were you, if you want to sell them, I would price them extremely aggressive right now. I mean, I would get very aggressive. And then we explain there's carrying costs. If you want to hang on to the house, put a renter in it, that's fine. But if you're not going to put a renter in it, let's say your carry cost is $2,000 a month and you decide to hold on the house for another 2 years, that's $48,000. So would you have been better off just to cut the price $30,000 and get it sold today? And again, real estate professional, which my wife was, for many years, competent realtors should be telling people the right pricing, not just to get the listing. They should tell you, look, it won't move at this price, and don't take the listing is my encouragement. If you're a professional realtor, don't take a listing if you're not going to have it priced to sell in the first 30 to 60 days, because we're just going to have a gluttony come to market, and you're going to see in certain markets, which I own property in, like Florida and Texas, we're going to see prices drop double digits.
Up next, we have 2 special guests this week because we have 2 special events in early September. We'll tell you about them next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. We track national political events and trends because they can affect your portfolio and quality of life in retirement. One of the foremost voices in the national political conversation is the keynote speaker for our annual September Speaker Series, and she joins us now. David, please welcome Becky Swansburg, CEO of Stonewood Financial.
Yeah, Chip, thank you so much. Joining me now via Zoom in the studio, if you will, Becky Swansburg. Becky and I have been friends for many years. Becky spent a long part of her career in the cesspool we call D.C.
That's right.
She is actually the one that coined the phrase, which we use quite often, legislative risk. And I've seen her do keynote after keynote many years. In fact, we've been on the same stages many times talking, and we each have software that we license to advisors to help them understand how to better put their clients in a better position with the tax code. You've written several books. In fact, we may be working on one together where Becky asked me to write the foreword of a book, so that was pretty cool. And that's just it. It's industry professionals get to collaborate with other ones, and all we want to do is convey great message to the clients. So welcome to the show. Thanks for jumping on.
Thanks for having me. Excited to be here.
So we were just talking before we went on air here is that you're booking your flight. So we're really excited. You are going to be our featured keynote this year in our September Speaker Series, which we have now put on for many years. We've had former Comptroller of the United States, David Walker. We've had leading economists like Strider Elos. We put on some pretty good guests, and you are no slouch when it comes to talking to folks about what is going to potentially happen in Washington in very real terms. What would that mean? What could that potentially change for retirement? So talk a little bit about what your messaging is, because not only are we excited to have you, but friends of mine have had you come give keynotes in their marketplaces all over the country.
Well, thanks. This is an exciting time to be kind of talking about what's going on in Washington because, of course, 4th of July, while we were all enjoying hot dogs and maybe the pool, Congress was passing and the president was signing into law the One Big Beautiful Bill. And I know that probably our listeners have heard a lot about this legislation. It has lots of tax changes, particularly for U.S. savers and U.S. savers age 65 plus. So it's a very important time to be looking at what's happening in the tax world because everything's changed a little bit. And I like to say what we're really working to do now is we are in this lower tax bracket rate environment thanks to the Tax Cuts and Jobs Act and then this one big beautiful bill. How do we leverage what is happening today in this lower environment to better prepare for what's coming tomorrow, which every indicator shows that taxes are likely to rise? And I think that's the important thing to remember, is that retirement is not about the next 4 years or the next administration. It's about the next 20, 30, or 40 years into the future. So it's really important to look at long-term trends and figure out how to leverage today's tax environment to address them.
Well, I think you bring up a great point. Is we are blessed that we are in a relatively low tax environment, historically speaking. The only time it was really lower was literally the first year and a half we put income taxes in place, when we had the top bracket at just 7%. That's going back 112 years. So, but for the last 40, when we've had major legislative changes, and I always talk about how the political aisle, which you, and I'd love you to talk in a minute about your experience working in D.C., but, you know, you had Tip O'Neill and Reagan come across the aisle, shake hands, and kind of, you know, do some things that got the economy going in a time that was needed. We lowered the marginal tax rates, which was great to start an economic boom. But in return for that, it wasn't a free lunch, right? That's when we started taxing Social Security, right? So, and then we had Clinton, who I think from the Democratic side of the aisle was probably one of the best economic presidents, if you just look at data. And he went across the aisle with Newt Gingrich, a hardcore conservative. And they had the Contract for America, but they made compromises. And they actually, following what I call the Laffer curve to point of diminishing returns, they actually raised taxes minusculely. It was a small move, but we proved you could do that with economic growth. So people get too politicized in this stuff, I believe. I always tell clients, look, I'm a registered independent. I certainly lean conservatively, fiscally, to the right. I'm open about that. But I always tell people I don't care about the party or the person. It's the policy. And that's why I think you are so valuable, because that's what you do. You dig into the policy, the likelihood that policy may change based on just looking at real historical data. So tell us a little bit tell our audience a little about your history working in D.C., kind of how you got in and how did you pivot that into our financial services career?
Yeah, well, I started out under the Bush administration, George W. Bush's first administration, in the White House press office. And then I hopped over to Capitol Hill. And when I was working on Capitol Hill for the Speaker of the House and a couple different members of Congress, I really thought kind of my career I'd make in policy. I was very interested in federal legislation. But more and more, it dawned on me how much these federal policies that we were debating and passing in the halls of Congress were impacting Americans in ways that they didn't always realize. And I saw it with my parents. You know, they were saving for retirement, and almost their entire savings approach was what I like to call through a personal lens. You know, how much income were they going to need in retirement? What kind of tax bracket would that put them in? How long would they be filing joint? And maybe would one of them become widowed and be filing as a single filer? But it was all about them. And when I worked in Washington, I realized all these decisions that we make about our personal finances, they exist in this ecosystem that is prescribed to us from the nation's capital. And that the decisions being made in Congress and in the White House, they can directly impact the success or failure of our approaches if we're not careful, if we hadn't aligned what we're doing financially with what's coming out of Washington, both short-term and long-term. So that's my real passion. What I'm excited to kind of share with our audience when I'm joining you in Omaha is really looking at what are the long-term trends and what can we do today to be prepared.
That's fantastic. Look, we were running out of time for this segment, Becky. We're really excited to have you out here. So just give my audience, let know the September speaker series is going to be Monday, September 15th at 6:30 p.m. at the Relevant Center out in Elkhorn. That's just off of Maple, just west of 204. But you must register. The public, you are welcome to come to this event. And most of our events, we don't always invite the public, so you are invited to this, but you must register. There will be limited capacity there, and I'm sure we're going to kind of sell out, if you will, this event. Becky does such a wonderful job. Becky, thank you so much for taking time to join us in studio this week. We'll look forward to having you.
Thanks for having me.
All right, Chip, what do we have next?
What we have next is a bonus guest to talk about a unique event coming this week to Retire Smart. David, please welcome retired Omaha police officer and now security consultant, Paul Milone.
Yes, once again, another special guest this week in the studio, Paul Milone of Ram Master Training. Paul is a former law enforcement officer right here with the Omaha Police Department and has since created an amazing training and consulting company. It consults law enforcement, he consults corporations and just the general public on how to be safe in your whereabouts. And we're really thrilled to partner with Hold the Line Foundation, which was formed by our good friend Chris Baker. Many of you may remember Chris Baker, who made some mischief on local radio airwaves for many years here in Omaha, has created this foundation. We are proud to be the first person to donate to it and have supported it in the years since, but they give back to law enforcement in many ways. And we came up with the idea of let's do a smart training series, help people be safer in their surrounding environment. So, Paul, thank you, and welcome to the show.
Oh, absolutely. Thank you for having me.
So give us just a quick rundown of your company currently, Ram Master Training, and kind of what it is you provide and what the audience can expect at the speaking event we're going to have hosting by you here next week.
Yeah, the Ram Master Training is first and foremost a firearms training company, but also a safety training company and some consultation. We do a presentation called SAPS, which is Situational Awareness and Personal Safety, and the training is varied regarding or depending upon the audience in attendance. It can be modified from junior high to high school age kids to younger adults, to adults in general, or women only, men only. But it's tweaked on each presentation for that particular audience on how you can be safe in society, and whether that is safety in crowds, your safety at your home, safety in a vehicle, the current crime trends and drug trends that, overdoses, things of that nature. So again, just dependent upon the crowd, I generally tweak the presentation for their benefit.
Man, that's awesome. So how long have you been doing this? I mean, how long have you been retired from actual law enforcement?
So I've been retired from full-time work with the Omaha Police Department for 3 years, but I went back 2 years ago as a training specialist in firearms and tactics. But I've been doing presentations like this informally for probably 15 years, maybe a little longer. And formally, I've been doing it for probably the past 5 years.
Fantastic. So our audience is primarily going to be retirees that want to go out and about and enjoy their retirement. But sometimes it's very real. I mean, my wife gets a little nervous in large crowds and special events. We host the Patriotic Parade. We're the primary sponsor right here in Omaha every year for the last several years. And when you get a crowd of 20 or 30,000 people, it can make some people quite nervous. So I suspect that this will give those folks confidence of how to just maybe be better aware of their surroundings, threat risks, et cetera. Is that kind of the stuff that you'll talk about?
Yeah, absolutely. And there's simple things that anybody can do in an event, an environment like that, to where, you know where an exit is, and you know where safety personnel are, and, just your personal whereabouts. It's really about being a cop, and more civilians, should keep themselves in that manner of I'm just aware of what's going on around me, and if something bad starts happening, there's no reason to pull out your phone and film it. It's just time to leave. And yeah, I'm excited to get to come out and present, and I really appreciate the opportunity.
Hey, we're really thrilled to have you out. We are running out of time for this segment. So, folks, if you would like to come to this fantastic presentation by Paul Milone from Ram Master Training, it's going to be held right here at the Midwest Learning Center, September 4th. That's Thursday night at 6:30 p.m., but you do need to register. Either call the office or go to retiresmartnow.com and click on the events tab and register. This is open to the public, and we're looking forward to having you here. Paul, we'll look forward to seeing you here Thursday night. Thanks so much for joining us.
All right. Thank you. Take care.
All right. My pleasure. Chip, what's next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go, David. First question is about an irrevocable life insurance trust, an ILIT. Someone told me I ought to explore an ILIT, an irrevocable life insurance trust. But it sounded really complicated. Can you explain it? Why would I do it? Who benefits from it?
Okay, so it's an eyelet, not an eyelid. So, I've had somebody ask for the eyelid, I-L-I-T, eyelet, right? And that's exactly right. It's an irrevocable life insurance. It's a trust created that you make a gift to life insurance. So if you own life insurance, so let's cover the basic. And by the way, it's not complicated. It's very easy to set up, and it's a few $100s in most cases to create one. So it's not that complicated. So there are many versions of trust, revocable and irrevocable. An irrevocable trust is you make a gift to a trust. You have given that asset away. In this example, life insurance, you cannot take it back. Okay, it's an irrevocable gift. So once you've done this, you can't change it. So why would you do it? How do you benefit from it? And is it complicated? The answer is no, it's not complicated. It's changing the titling on life insurance you may currently have in place. Or if you work with a competent financial professional, they may recommend a life insurance policy put in place on you or your spouse or both in what's called a survivor life policy. In other words, it insures 2 heartbeats, not one, makes it cheaper to buy typically, to prevent your estate from having to pay inheritance or estate taxes, or at least to cover said taxes. Now today, Chip, we have a very high estate tax exemption. It was just pushed through in the big, beautiful bill, permanent until the next election cycles as far as permanent goes. You can exempt $15 million of assets before you have to pay the federal government an estate tax. But that number was scheduled to go to $5 million, and most likely will get cut in the future when our government needs to pay off the revenue. So by placing your life insurance, let's say you own $1 million life insurance policy right now. You've had it in place for many years. You bought it. Maybe it's a cash value. Maybe it's a permanent policy, a whole life policy. These were very common, sold from the big box financial firms like Mass Mutual and Northwest Mutual, et cetera. There's nothing wrong with owning them. And they build up this cash value, but most people realize they don't need it. It's an extra asset, but they have this $1 million death benefit. That death benefit will always pay out to your beneficiary, most likely your children, 100% income tax free. However, that benefit, that death benefit, is calculated as a value as part of your estate. So if in the future the estate tax, say the exemption goes back down to $5 million, as many people are predicting, and let's say you have an estate worth $10 million when you pass. Maybe you own a simple family farm and realize the value is up there. The $5 million that is over that threshold would be susceptible to up to a 40% tax federally. Of course, Nebraska is one of 6 states that still imposes an inheritance tax. And my home state where I was born in Baltimore, Maryland, is the only state that charges both on the state level an inheritance and an estate tax on top of the federal taxes.
40% of $5 million, $2 million bucks?
You are correct. So what you could do is if the life insurance was held outside of your estate, that $1 million is not. So if you had a $10 million estate with land and investments, that $1 million death benefit takes it to $11 million. You'd pay 40% of that as well. But if it's inside the irrevocable trust, it is not calculated for part of that tax. And you can use that cash to pay the tax. So it just takes planning. Right? And whether you believe legislative risk, something we'll be talking about at our speaker series coming up, has the ability to change us in the future. So we recommend everybody, if they have permanent insurance and they're not going to need it, to remove it from ownership and place it just to be safe. And it's a very simple thing to do, but it's a great question.
Boy, well, there's the answer to the question. Why do it? Tremendous tax advantages can flow from it. All right, David, the next question. Well, speaking of inheritance, the next question is about inheritance. How wise is it to count on an inheritance as part of my retirement plan? Unless something goes horribly wrong, I'll get a significant amount of money from my mom, which would more than cover my income needs in my later years. I don't want to rely too heavily on that money, but I also don't want to save so much now that I can't enjoy my present life and then end up with more than I need when I'm 75. How should I approach this?
Hey, this is a great question. It's a very real planning question that you should be talking with your financial professional about. So, do you know the inheritance amount? And it's great if parents have shared that with you. However, if there's other siblings, are you sure that, so first thing was, are you sure that that's really the plan? Because sometimes people expect an inheritance and lo and behold, mom and dad gave it to the church or charity.
It can get ugly.
Yeah. And so having these conversations with your parents, if they're coherent and alive, is a great tool. The other thing is we could start gifting strategies now where the parents, to avoid the estate tax we just talked about in the previous question, could potentially start to slide some of that inheritance down to you now to benefit you. So it's about having a good, holistic plan that covers your income needs now and in the future, the taxation of those income needs, both your assets and the ones you might inherit, the risk management of your portfolio, because all this can be dialed in with some really in-depth questioning by a competent advisor. So it's a great question, and you should sit down with a professional to work through this, and then we'll have a good idea. How much do you want to weight that inheritance, right? When do you think it will happen? The other thing is your parents may live longer than you think. Longevity is a very real thing, so you may not get those dollars until you're older. We have a client who is now 75, and parents are still here with us. We had one parent, the parent of a client, turn 104. So, I mean, I think that's fantastic. So, again, don't count on that money coming too quickly.
David, one more question. This one is about debt versus savings. I have about 4 years left until retirement, and I'd really like to have $1 million in my 401k when I finish working. I should be able to achieve that if I save aggressively, but I also have a lot of debt. Should I focus more on paying off the debt or piling up more money in my account?
I think we had a similar question last year, at the end of the year, when I talked about the story where I paid off a mortgage I really didn't want to pay off, right? An interest arbitrage, right?
Well, how expensive is the debt? That's what it came down to.
So that's the exact thing, is you need to do a calculation or have us do it for you. We're happy to do it. Is what is the anticipated earnings? How long a time horizon are you going to continue contributing to that 401k? When are you retiring? So if it's 3 to 5 years out, we wouldn't say take an aggressive stance. But if it's 7 or 10 years out, we love that idea. In other words, you got some time for these assets to grow and work and go through markets ups and downs, et cetera. How much are you averaging on a diversified portfolio, and what's the interest rate you're paying? Now, hopefully, again, we don't know. Hopefully the interest you're paying is reduced because you maybe refinance some of that debt at lower rates in the past few years when rates were suppressed significantly. Rates ran up the last 2 years or so, but it's an interest arbitrage. Are you earning more than you're paying in interest? Then let that positive arbitrage run in your favor, and we'd be happy to help you dial that calculation in. Great question.
Up next, according to Penta Investments, high net worth investors are gravitating to annuities. We'll explore that next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. David, we are going to talk about high net worth people gravitating to annuities, but we have a few items to hit before that. Zero fear in the market makes me fearful. Were you practicing some Zen there, or what did you mean by that?
Yeah, I posted that on what's called the VIX, a volatility index that measures fear, and the lower that goes, the less fear is perceived in the market. Historically, when that gets down around 13 or 14 score, that usually is when nobody's looking for something happening and just something all of a sudden does happen. And ironically, I posted that, and the next day we had, over 1% moves down in all the major indices, et cetera. And so it's just telling you, when there's no fear, that's the time to maybe be cautious, right? Because something may come out from left field or something may expose it. Now, we're recording this show a little early this week on Tuesday. Wednesday of this week, which by the time you hear this show will have already happened, NVIDIA, one of the most important earnings numbers we'll get, will have reported after the closing bell on Wednesday. And that will really set up if September, are we going to see the historically, and September, just historically is the worst performing month in the S&P 500. Are we going to see a sell-off, or at least just a kind of a pullback, which also, ironically, historically happens in the first year after a presidential election? This seems to be the malaise time of year. Again, I just study data. Doesn't mean it's a prediction or going to happen, but things we're paying attention to.
Well, speaking of studying data, you noted that at the beginning of this week, the market started down, and you posted a chart. You shared with the team a chart saying, last several years post-Jackson Hole. Notice this pattern, not necessarily prediction. First, you better describe, what do you mean, this reference to Jackson Hole, and what are we seeing in this chart?
So every year there's a major meeting at Jackson Hole where the elites of the financial world, if you will, come together, and the president of the Federal Reserve always gives a speech here. And it's one of those where he's kind of laying out what they think they're seeing for the second half of the year. So the chart, for those you can see it, what we did is laid out basically the last 7 Jackson Hole events, and
there's a dip every time.
Yeah, ironically it is. Again, that causation is not and correlation are not the same here. But again, if we don't study history, we're certainly doomed to repeat it, right? I loved this type of data. Not that I'm saying it's going to happen, but hey, what if it does, right? So here's something to pay attention to. And why does that happen? Well, typically when the Jackson Hole meeting happens, we're referencing going into the fall. The earnings season of the second quarter typically is just finished. So all the news that can move markets higher typically goes away, and we seem to have a little bit of a fade. And again, it's just data. So pay attention. If you have too much risk in your portfolio, it may be the opportune time to get someone to analyze that risk and maybe make some allocation changes, slight shifts to de-risk your portfolio so that if the market were to correct 5, 7, 10, 12, 15%, maybe you don't have to experience the entire drawdown.
David, I'm going to hit you rapid fire here with 4 items in a row and under the Economics 101 heading. You know, we do this periodically, and you shared this with the team last week, New York Post headline, New York City companies all but stopped hiring in the first half of the year. Why do we think they've stopped hiring?
Well, you have the political environment in New York is such that the next mayor, which the election will take place, I believe, November 4th, is most likely, it's a high probability, like 80% right now, will be a full-blown socialist. And so companies are realizing, wait a minute, this is not going to be good for us. So they just, never mind, we just won't hire anybody. And you're going to see New York City go through some economic pain it has not experienced since pre-Rudy Giuliani. If you remember, New York was in dire straits in the early 80s, and crime, things got out of control. And they had to put their foot down, and they cleaned. I mean, Times Square, I remember going there with my dad. My dad had a couple of different businesses, but we used to go to the Diamond District, which is not too far off of Midtown there, to buy some things that they gave away in their business, and diamond tennis bracelets. My brother Luke's probably smiling remembering that. But anyway, I remember going there, and literally I would have to hold my dad's hand. It was not you would not walk your kids in Times Square. Not the Times Square you see today if you've been there in recent years, right? And Rudy Giuliani, and they put in policies to clean it up, and tourism came flooding back to New York City, and they boomed economically. And right now they're headed the other direction. So anyway, that's just word of the wise. Be careful.
All right. Well, speaking of heading the other direction, from the Financial Advisor website, the headline is How Advisors Are Helping the Wealthy Flee New State Taxes. How many times are we going to keep seeing this scenario play out?
And that's exactly right. These advisors have a job. If you live in a high income tax state, New Jersey, California, Hawaii, New York, and many others, frankly, advisors have a fiduciary obligation to help their clients understand their tax liability and what moves they could make. And there's several of them. They can use some different investment vehicles to defer taxes for a few years. They can make some shifts. They can move their residency. As we've talked about, money will get up and walk away. We'll post the article. It's a pretty interesting read.
Well, and in case people aren't getting the message, there's a statement out on social media now from Marcus Lemonis. I hope I'm pronouncing his name correctly.
That's correct, yep.
He's the executive chairman of Bed, Bath & Beyond. And David, this isn't usually done. He just blasts the state of California for regulations and tax policy and says, we can't do business here.
Okay, so there's a show, or at least there was a show called The Profit on CNBC many years ago. Marcus Lemonis was the host of that show. He would go in and potentially invest in your business and turn it around, something he's a specialist at. He's also the CEO and major shareholder of Camping World, right? And you may have seen the flag controversy there. They put up a giant American flag at every location, and one such city said, you can't have that flag. And he said, we'll just pay the fine. We're not taking the flag down. But he blasted this, and then current governor and presidential hopeful Gavin Newsom blasted back. Oh, is this the company that went bankrupt? Just so we're clear, Marcus Lemonis' company, Bed Bath & Beyond, is not the Bed Bath & Beyond that went bankrupt. They bought the name and the name only. That company did go bankrupt and completely out of business. This was the former Overstock.com that he's the chairman of, that changed its name to Bed Bath & Beyond and is basically mainly selling online. And now they're just now starting to open retail locations. But
Newsom
they are not.
Steps on a rake again?
Yeah, and they are not going to. And so,
well,
anyway, it's been a
story.
Twitter spat, fun to watch. But they are not going to open stores in California because it's just an environment. They won't defend crime. So people will come in and walk out with $900 worth of stuff. Oh, that's not prosecutable. And people are just done with the madness. So your money and wealth are going to migrate where they're treated fairly, period.
He made it very clear, we'll still service California customers online, but we are not going to set up shop in California.
Well, I believe there's a better way, and I think there's no better argument of that than our friend who is now present in Argentina, right?
Well, that's our next story. You mentioned this before. I know you've been itching to get at this. Javier Milei, he of the chainsaw in Argentina, and we've got some data now. We've got some distance. We've got some runway for the Milei presidency in Argentina. What are we seeing, David?
Well, everything is working out in his favor. So inflation has dropped, right, by 15% or more on almost every category. The poverty rates have skyrocketed to the bottom, and it was not skyrocketed, but plummeted. And Argentina is now a global champion of growth, and their GDP has been on fire growing. So all the metrics you want to see, because he does not have to go through the same partisan congressional malaise that we do. Now, look, I'm not asking for a dictatorship in any way. People think Trump is already authoritarian. But we need Congress to get their act together and start gutting the federal government. Smaller government leads to economic growth, and capitalism rises all tides. I mean, we've seen it throughout history. Nothing has gotten more people out of poverty in the world than capitalism.
Rising
and nothing has murdered more people than communism and socialism, and the data just proves it.
Yeah. All right. Well, there's our economics 101. You do things the right way, you attract people in business. You do things the wrong way, and you drive them away. All right. Now, finally, David, we arrive at this headline that you sent to me. Why high net worth investors are paying more attention to annuities. So an annuity may or may not play a role in a properly ordered portfolio, but what's going on here?
So for the high net worth person, you need to understand is when you put money into an annuity, and there's many types of them, okay? So, and we're not recommending an annuity or anything right now. Just understand that an annuity is simply a vehicle that tax shelters your money the time you're in it. So if you happen to be a high net worth individual and have high income, but that income is going to change, maybe you're going to sell a business or exit a business 3 years from the future, 5 years, 7 years in the future, and you have $2 million in a trust account kicking out $50,000, $80,000 in taxable dividends every year that you don't need or want, there's a couple things we can do. We could restructure the portfolio into more growth-oriented assets that don't send out taxable dividends, or we could shift some of those assets into an annuity. And again, there's many types. The article references a variable annuity. Now, we're not big fans of variable annuities because they usually come with a kind of high fees, and we're very fee conscious. But
fixed index annuity, I know we like those.
Yes, because they have zero fees in this situation. Exactly that. So and they're going to be tied to some form of gain of the market if it goes up. So if the S&P 500 rallied up 20%, you might get 8% of that or something in a fixed annuity. But that growth is not tax chip like it would be in your brokerage account. So for a high net worth individual that we're trying to do other tax strategies, right? Or we're waiting to an exit of a large business or a farm sale or something like that. In the meantime, we might want to place some of those assets in there where those dollars grow and we don't have to pay any taxes on them, lowering your current tax liability that we can maybe compile with other tax saving strategies, a la, for instance, a Roth conversion. If I could shave $80,000 to $100,000 off a high net worth individual's taxable income every year and then do a Roth conversion for that same amount, I've not increased their tax bill, but I've increased their net worth typically, right? There are so many facets of this. That is why proactive tax planning is so important for a well-designed retirement plan. And you don't have to be a high net worth investor to benefit from that proactive type of planning.
Come see us if that kind of scenario could benefit you. But that'll do it for this week. Please visit our website, retiresmartnow.com, and click Attend an Event at the top of the page to see everything we currently offer. No obligation, no charge for our events, but you do need to register. You can do it online or by calling 402-369-7777. David, bring us home.
Have a blessed week. Go Big Red.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week. University of Nebraska and University of Nebraska Athletics, also known as Nebraska Cornhuskers, are not clients of Smart Wealth LLC nor Retire Smart LLC. Playfly Sports Properties, on behalf of the Nebraska Cornhuskers, was compensated for this endorsement as such term is defined under SEC Rule 206, subsection 4-1. For further information about this sponsorship and the compensation details, visit retiresmartnow.com and click on the Sponsorships tab. Paul Milone and Hold the Line are not clients and were not compensated for his appearance or any implied endorsement. Hold the Line is a 501c3 charitable organization that will sponsor the personal safety class being held by Retire Smart. Becky Swansburg and Stonewood Financial are not clients and were not compensated for her appearance on this show or any apparent endorsement that it might imply. However, Becky Swansburg will receive a $10,000 fee for appearing at a speaking engagement sponsored by Retire Smart.